Right. Hi, everyone. Happy Thursday. Welcome back to another episode of Bits and Bips, the interview. I'm your host, Steve Ehrlich. We're here after a few week hiatus and a lot to discuss. First, I want to introduce my special guest, Zach Pandl, Director of Research at Grayscale Investments. So welcome, Zach.
Hey, Steve. Great to be here. Lots to talk about. Happy to get into it.
Yeah, absolutely. From the Fed intrigue on I guess Monday or Sunday night when word leaked of Jerome Powell being investigated, to geopolitical tensions all around the world that are making my intelligence analyst brain really kind of go exciting. The very first country I ever worked actually was Venezuela way back in 2008. So that, and then obviously all of the negotiations surrounding the market structure bill, and whether or not it's going to pass. Is there a way forward on a few key sticking points, which we'll get into? And on top of that, Bitcoin, ETH, and the broader market seeming to brush all of this off and remain buoyant as it enters an exciting but potentially dangerous period of time, or trading range where in the past it's retreated. But there might be a few signs that things are going to be different this time. So we'll get into all of that. Before we do, just a little bit of housekeeping. Nothing that you hear on this program is investment advice. Please see unchained.com/bits and bips for more information. And before we dive in, I'd also like to just take a brief break so we can hear from some of the sponsors who make the show possible.
If you look at most apps today, they depend on quite a complex mesh of different infrastructure, a lot of which is centralized. Walrus is a decentralized data platform. It's particularly good with large, unstructured data files, and it allows you to store and use those without dependency on any centralized systems. It works really well as part of the SWE stack. It was created by Miston Labs, who are also the originators of that SWE stack. And what that means is natively together, they allow developers to build with trust, ownership, privacy baked in right from the beginning. And what this does is it allows you to build use cases that monetize data in ways that just have not been possible before. So there are whole new revenue streams that are now available to builders to come and build on Walrus.
Okay. All right. So let's kind of dive right into this. Zach, we're talking a little after noon Eastern time on Thursday. And I guess late last night, word leaked that Senator Tim Scott, the Republican chairman of the Senate Banking Committee, has decided to delay, potentially indefinitely, a markup session for their version, or his committee's version, of market structure bill. And this kind of came after several days of discussions, negotiations about a few key issues, ethics concerns pertaining to President Trump and his family and close advisors as it pertains to their involvement in crypto. There's a lot of questions about DeFi and how and whether it will be sort of regulated under this legislation. And the really big one relates to stablecoins and yield, because something that came out of the Genius Act was some very clever ways for stablecoin issuers and companies associated with the stablecoin ecosystem to sort of indirectly provide yield, which, at least according to the banking lobby and I guess some of the senators who helped draft the Genius Act and bring it to law last year, is against the spirit of what was intended. And the banking lobby in particular wants to close that this time around and sort of have a bit of a redo when it comes to the Genius. So I know you're not a DC lobbyist. I know you're not a policy insider, but it's been impossible to ignore the story. So I just want to briefly start off by getting your reaction to what happened.
Yeah, thanks, Steve. A very intense week for the crypto policy community and all the legislators and staffers working on this topic. Look, taking a step back, we see a very encouraging trend on regulatory clarity for the crypto industry here in the United States. President Trump came into the office with a mandate from voters to work on these topics, and we've made huge strides. The Genius Act that you mentioned, all the changes from the SEC and other agencies last year, including things that are quite central for an asset manager like Grayscale, generic listing standards for exchange-traded products, for example. So we've made huge strides. And those are going to continue regardless of what happens on the market structure bill. We're going to see more progress from the SEC, for example, this year, more ETF product launches. So to me, the trend is very positive. That being said, this piece of legislation is quite important. There's lots of different types of crypto industry players, and they have different interests in the legislation. Grayscale is an investments business. We're helping investors get access to crypto assets safely and securely and build them into diversified portfolios. So those are the things that matter most for us for this legislation. And what that means is really the Section 1, Title 1 of this piece is the most important for Grayscale, and that's clarifying the commodity and security status of tokens in the market. That's what's most important for an investments business like us. So we're pretty happy with how that piece of legislation works. I agree with all the industry players on some of the other important issues, the protections on DeFi, the need for stablecoin yields. We're focused on really that first section, regulatory clarity on the assets that are in the market today, which will allow issuance of these assets to pick up, and that's great for investors, the clients that we service. So that's really the kind of the Grayscale perspective. We're happy with how Title 1 of the legislation looks, and we're going to let some of the other industry players battle on some of these other important topics.
Yeah, it seems like this is one area. I mean, after Grayscale had been in the news for years and years, fighting with the SEC to convert GBTC to an ETF, et cetera. I guess maybe it's a little nice that you guys not necessarily are sitting on the sidelines, but you're not quite the central player in this particular fight.
And we'll let other people battle those fights today. We're very happy to see regulatory clarity coming for the industry, broadly speaking, and it feels like it's happening at a very rapid pace from our standpoint, from the standpoint of an ETF, crypto ETF issuer. So things are moving in a good direction. These are all important issues. DeFi protection, stablecoin yield, very important issus, but we're letting other players take the lead in those negotiations at the moment.
Right. I mean, you've gotten clarity on staking, so you're allowing that first market ETFs. And I guess it's really more just, I don't know if accounting was the right term, but if you're going to file new products under the 33 Act or the 40 Act and some of that type of stuff. I know you offer some DeFi products, and theoretically, like depending on treatment of DeFi and adoption, that could have associated impacts on demand for that type of product, but I get it.
Absolutely.
That said, I mean, you've got decades of experience in finance and in particular in Wall Street. So I really want to get your sense of like what's going on at banks. Like what is your sense there? Because it's hard. The stablecoin yield, I mean, that's a big discussion, although there is a bit of dichotomy between like, for instance, B of A and JP Morgan. I mean, some are more cautious or concerned about stablecoin yield sucking out deposits and liquidity versus others. There's accusations that these big banks are hiding behind community banks to sort of protect their own turf. And all of this comes within the context of President Trump, I guess, trying to mandate a 10% cap on credit card fees, which could really be devastating for bank credit card issuers, their finances, or really restrict credit in the ecosystem if they can't service certain communities profitably. So that's the bigger context. I mean, what do you see there from the bank's perspective?
Well, a lot of moving pieces. On the narrow issue of institutions, traditional banks, investment banks, broker dealers engaging with crypto. Look, what we see is everybody is building, and nobody is going to wait until President Trump's signature hits the legislation to begin building in the space. There's lots of competitive dynamics at play. If you wait until the legislation is done to begin kind of planning and investing, you're going to be behind your competitors. So all these big institutions have been engaged with crypto in various different ways, really for the last couple of years. And that process is accelerating as the regulatory rulebook is getting more clear. So what are we going to see? I think the things that the visible things that people are going to start to see this year are, first, stable coins showing up in lots of different places. Stable coins on corporate balance sheets in their official SEC filings. Stable coins as collateral on big derivatives exchanges. These are going to be some of the big visible things that you see Wall Street banks doing. And then you're going to start to see, I think, probably after the market structure bill gets laid down, banks engaging with blockchains directly, interacting with their own wallets, their own directly holding crypto assets on balance sheet and engaging with the blockchains. And then the kind of last piece, and the thing maybe that I'm most excited about following this regulation, is issuance. You look at big companies, they have lots of different ways to finance their business or ways to optimize their capital structure. They issue stocks, bonds, hybrid instruments like convertibles and preferred stocks. In the not too distant future, our view is that they will also be issuing tokens, crypto tokens, blockchain-based tokens as a part of their capital structure. And regulatory clarity is going to allow that to continue. Mm-hmm. So I think an explosion of issuance from large businesses of tokens as a natural part of the capital structure is going to be one of the biggest implications of regulatory clarity in this space. So lots going on, but in my view, issuance will be the most long-lasting and probably has the biggest implication for investors, the clients that we service at Grayscale.
Yeah. So just to follow up on that, and then we'll move to markets, which is I know your real area of expertise. Who do you think has the most to gain or lose from all of this? Like who's going to benefit the most? And I guess the answer could be a little bit depends on how the final bill, if there is a final bill, how it's constructed. But who's got the most at stake here?
Yeah, look, when we look at decentralized finance, right, I think that the bigger picture vision is that we're going to compete with all aspects of traditional finance, all aspects of trading, lending, payments, custody. We're going after all of those things. But decentralized finance excels at a couple specific things today. And these are things like cross-border payments, mm-hmm. trading of crypto native, and collateralized lending. So focus on those issues. I would think those are the things that are most at threat from continued growth in the crypto ecosystem. The decentralized finance is cross-border payments, trading of crypto native assets, and collateralized lending. The parts of the large banks, large financial institutions that engage in those businesses, we're going to go after first. Yeah. And eventually, many other things, trading of equity securities and bonds, uncollateralized lending. We'll get to all of those things, but I think those are sort of next generation DeFi. Today, I would focus on those specific pockets. The banks are very well aware that their margins in those business are the things that are a threat from DeFi. And so, they are preparing, either investing in stable coins or other infrastructure so they can hold back the industry or at least compete alongside it as DeFi continues to grow.
Gotcha. Okay, so let's turn to the markets. I mean, it seems like Bitcoin, ETH, and a bunch of alts are, I guess, I don't know if ignoring is the right word, but they're certainly taking some of this turmoil in stride. I mean, Bitcoin briefly touched, I think, $97,000 last year, the first time in months. It's up 10% on the year. It's dragging a bunch of other tokens along with it. I mean, the rally really seemed to start a little bit with everything that happened with Jerome Powell and I guess U.S. Attorney Pirro over Sunday night, and I guess concerns about an increase in easy money, et cetera. But these assets are jumping, and I'd love to really kind of understand, because you go very deep into the data, why. And the real question, I guess the real two questions then on people's minds are, one, how sustainable is it? And two, how high could we go?
Yeah, lots to dig into. And I think maybe we could separate the kind of fundamentals and the fund flow topics, the technical topics. As you mentioned, Steve, we look at both of those things at Grayscale. You have to look at both of those things to understand why any asset moves in the market, definitely Bitcoin and Ether. That's the case. Maybe just starting briefly from the fundamental side of things. Look, I think the regulatory clarity piece is an important piece of it. But as you say, as the kind of odds of this legislation are moving back and forth, it's not directly translating into markets right away. I think that's partly because people still think this legislation is going to get done. But I think the bigger piece of it is that the number one driver of capital flowing into crypto is demand for alternative stores of value. It's this macro imbalances that are driving capital into foreign currencies, into precious metals, into industrial metals. These are the same forces that are driving capital into crypto. And to me, that story keeps getting bigger and bigger. And you can look at things like gold, silver, platinum, palladium, everything that is happening in the precious metals. Clearly, the debasement trade still running there. And I think basically the debasement trade has arrived in crypto in the last couple of days. So that's sort of a fundamental perspective.
And that's overriding any of sort of like the endogenous things that are happening in crypto right now.
Yeah, I would say maybe if I had to put a kind of rough number on it, I'd say it's sort of 70-30, 70% the kind of macro trade, dollar debasement trade, and 30% the regulatory trade. Again, like just to roughly approximate my own thinking. And then the fund flows are very interesting. There's always a lot of moving pieces. But I think primarily the driver at the moment is the ETFs or ETPs, exchange traded products. We use those terms synonymously. In December and in the very beginning part of the year, it was all about kind of a tax related trade. You had $1 billion come out of the Bitcoin ETFs in December, and $1 billion come right back in the first 2 trading days of this year. That's a sign that probably there's people realizing tax losses in the 2025 tax year and then buying back those positions at the start of the following year. I don't think it suggested anything fundamental. And then in the last few days, you've started to see some of those real longer-term fundamental capital flows come back into the ETFs. And that's really the flow story. Why price is up is the ETFs have come to life again. And that's what we want to see. That's what we'd expect to see. The ETFs are the natural place for institutions, for intermediated wealth to access crypto. We're starting to see that now. And I think it's driven by both the macro story, a demand for alternative stores of value, and to some degree, improved regulatory clarity. Gotcha. And happy to dig into the other types of flows, derivatives, and some of the OG whales, some of the big stories from Q4. But I think it's the ETFs that have been the big mover since the start of January.
Great, and we will get into that stuff. But I do want to ask you about just at least flows for your ETF. I know sometimes it's hard to know exactly who's buying your stocks or who's trading them, but I am curious, like your sense, are these big institutions, is this retail? Are these flows coming from RIAs that have mandates now to offer these products to their customers? Like what's your sense of actually who's buying it? Because I have seen a lot of reporting and data suggesting that in this time it is largely a retail-driven, spot-driven sort of surge in demand, at least for now. Derivatives volumes and open interest remain somewhat flat. And I think even the Bitcoin funding rate I saw was negative. So it seems like it's really a spot movement. And I'm curious like how that correlates to what you're seeing, at least when it comes to GBTC and broader ETF flows, which I'm sure you track.
Yeah, absolutely. Crypto derivatives markets, especially that offshore market dominated by perpetual futures, is still pretty quiet. We can talk about that more at length. It really has not been a re-leveraging of the offshore futures market driving prices recently. It's been real money or fiat currency being converted into Bitcoin through the ETFs coming into the market. And who is the buyer? You mentioned that there's lots of different types of buyers. There's retail, there's traditional institutions like pension and endowments. But the big piece in the middle of the bell curve for the ETFs is advised wealth. Okay. And this is RIAs, as you mentioned, independent wealth advisors, but also increasingly the broader platforms are onboarding our products and other crypto ETFs, and advisors are building them in to diversified portfolios for their clients. We think that this has a very long way to go. So our data would suggest that conservatively there is less than 0.5% of U.S. advised wealth allocated to the crypto asset class. And I would say it's probably even quite a bit smaller than that, but conservatively less than 0.5%. That number probably grows to a few percent over the coming years.
And if I could interject, apologize if you don't have the number off the top of your head, but what is 0.5% of like advised wealth? Like what does it actually mean to make it tangible for
it's like a couple $100 billion, $100 billion, something like that. U.S. advised wealth is probably a $40 trillion or so industry. There's no exact precise number, but 45 trillion in that ballpark. So you have a lot of money that has moved into the crypto ETFs, of course, over time, also into digital asset treasuries like Strategy or MicroStrategy. And we count all of those things together. When you look at the portion that's held by advised wealth, again, all added up, we still think that is a good deal less than 0.5%. And so when we look over the coming years, Grayscale, we'll focus on all those different investors, institutions, retail, but advised wealth will be a huge piece of it. I think that this will be a very steady source of demand for capital inflow into the ETFs, and something that will create a persistent bid for Bitcoin, for Ether, for some other altcoins over time.
Yeah, I think so too. I mean, I'm going to try to do a little math in my head, and it might not be a good idea because I actually made some mistakes helping my fourth grader with her math homework last night. But I think JP Morgan came out with a report saying that there was about $150 billion of inflows last year into crypto. Does that sound about right to you?
A bit less than that. I mean, if you look at the net flows for all crypto ETFs, just the ETFs, and maybe
but not just ETFs. I mean, I think you're talking about treasury companies.
With the DATs, probably it reaches that number. Yes.
Yeah. So so I'm just thinking like a couple $100 billion in advisor denominated funds. Like it would be much less than. Well, I messed up, I think, doing math again, but it's much less than 0.5%. It seems.
Correct.
So I'll stop trying to do that. All right. We have a lot more to get to, but we need to take one more break so we can hear from the sponsors who make this show possible.
Before we built Walrus, what we heard a lot from developers was the need for speed, and we had it ourselves. So reads and writes are extremely fast on Walrus, and this means that apps don't lag even with really large files. Privacy was another thing that we heard a lot about, and Walrus lets developers encrypt data with our primitive called Seal. And with that, you have full control over who accesses your data, and everything is enforced on chain. And this enables these really incredible use cases that haven't been possible before. Everything from more reliable AI models to data markets where users can monetize their data. So if you put this all together, what this actually means is the developers can finally build apps and they feel Web 2 fast, but you've got Web 3 level guarantees.
All right, so let's pick up where we left off. The real question now, I mean, it seems like some of the fundamentals are much more encouraging than perhaps other brief rallies. And the real question now is what happens next? Bitcoin, like $100,000. We haven't gotten there yet, but that's a very psychologically significant price point. Typically, when Bitcoin has these surges, the long-term holders are selling, although I've seen some data suggesting that those sales have slowed down and profit taking may not be as robust this time around. But what are you seeing? Like, do you see the potential for a breakout back into six figures? What would it take? And sort of, are there any like big stimuli catalysts out there that could sort of help build grow the narrative, like the bullish momentum? Because I know traders are starting to get a little more greedy.
Yeah. Look, I think the fundamental pillars driving the bull market very much in place. And those are the two things that we've touched on: macro demand for alternative stores of value, regulatory clarity. I see a series of catalysts from both of those things over the next few months. In terms of price predictions, we typically don't do price targets, but we have said, Grayscale has said that we think Bitcoin reaches a new all-time high in the first half of 2026. So we hit 126,000.
This is just you and me and a few thousand friends. So
that's right. Between you, me, a few thousand friends, we think something above 126 by June 30, something like that is a reasonable summary of our expectation. But what we're trying to get across, Steve, is, we think the bull market is moving ahead. We think that there are these fundamental drivers, and we think that there is plenty of room for capital to enter the crypto ecosystem and drive up valuations, and most of that likely to be through the ETFs. But I think, some other things are re-leveraging of offshore futures. We may see that as the kind of speculative piece of the market comes back. So that's sort of the high level picture. What are the risks to that? Things are looking pretty good right now. What are the risks to that? Like when I look back at the fourth quarter and all the things that happened, look, with the benefit of hindsight, it looks like basically an OG Bitcoiner crash out was the main reason for the underperformance of price in the month of November, which was really the key month in Q4. We can see that on chain. There were these two big events last year, one in July, one in November, where a lot of old coins moved on chain. And I think that essentially this is a sudden kind of profit-taking moment by some of these OG holders. When we think about where Bitcoin is going over the next few months, that's really the question mark. There's a lot of positives from a fundamental side, and I think new capital coming to the ecosystem. The risk that we're underwriting, being long Bitcoin over the coming months is uncertainty about some of that OG holder behavior. Do we continue to see some profit taking by long-term holders that holds back the price from reaching all-time highs as soon as I think it will? I think that we are mostly through that. I don't predict more of these big liquidations by OG holders, but I think we need to acknowledge they were a factor in 2025. They are a little bit hard to predict in terms of timing. So that's going to be a thing we need to be watching over the coming months. The good news is it's all very transparent on chain. That's the great thing about the Bitcoin blockchain. You can see all this activity. We'll be watching out very closely to see whether we see more of those large profit-taking moments by some of the early Bitcoiners this year.
Okay. So let's talk about a few other assets then. I mean, let's talk about ETH. I know that when things are going well, ETH can actually be, I guess, deflationary, but it has a very different value proposition from Bitcoin. What are you seeing there? And maybe we could also talk about Solana too. I mean, like the two big L1s. How are they behaving differently, and how does like sort of this debasement trade affect those particular assets, or are there other drivers that are really impacting what's happening there?
Yeah, great set of questions and a lot of nuance. This is a pretty sophisticated crypto audience, so I think we can talk about some of that nuance on this call. Look, obviously, Ethereum smart contract platform. In some ways, it benefits more from regulatory clarity than Bitcoin. Bitcoin is building some of these things, layer twos and all that, but they're all quite early stage. And there's some other regulatory questions like taxes on de minimis Bitcoin transactions, et cetera, that'll matter more for Bitcoin. But when we're talking about unleashing DeFi, stable coins, tokenization, Ethereum will benefit more from that. So if we get regulatory clarity, with the market structure bill, with more actions by the SEC this quarter, my view would be Ethereum continues to outperform. So I think Ethereum very well placed here in that regard. I also think that Ethereum may be different from Solana in that it has some of the macro bid behind it. Bitcoin is in demand as a alternative store of value and monetary asset. Ethereum is not exactly the same as Bitcoin, but I do think it is considered by many investors as a scarce commodity because of relatively low inflation, and maybe captures some of the macro bid as well. So I think Ethereum very well placed for both of those reasons. As your listeners know, Ethereum can't do everything. It has more slower block times, higher cost of transactions, et cetera. So, many of the other smart contract platforms also will benefit. Solana, tons of positive things going for the Solana ecosystem. I think it will continue to be a leader in this space, particularly on things that require higher turnover, tokenized equity trading. I think something that Solana continues to lead in. I would expect a lot of growth in that area this year. And then some of the other smart contract platforms are going to be coming on board. Maybe just briefly from a Grayscale standpoint, we're thinking a lot about the ETFs that will become available this year. We have Ethereum ETFs, obviously Solana ETFs. I think investors can expect more of the smart contract tokens to be available to mainstream investors through the ETF structure this year, and that potentially also helps them capture a bid. So, to summarize, I guess if I had to put kind of one of the major assets at the top of the list for myself, starting off 2026, to me, Ethereum stands out in a lot of ways because it benefits from that regulatory clarity, and probably it also has some of the macro bid. The ETFs are ready. We're staking in the ETFs. So it's really ready for institutional adoption. And I think many of the other smart contract platforms are going to perform very well also, but they are more about that regulatory clarity and adoption of the technology and less about the macro bid for these assets.
Gotcha. So at the risk of, I guess, going back to the market structure discussion that we had, I am curious. I mean, since you mentioned ETH, like, are there certain smart contract platforms, L1s, that have more at stake than others? I mean, I know that ETH dominates DeFi, especially in terms of like TVL and high value transactions. Other blockchains are making plays to get a piece of that DeFi pie successfully. I know iTrack, UTrack, the rise of like tokenized treasuries, money market funds, etc., across blockchains. Which ones, in a very not official investment advice type of way, like which ones do you see as having the most at stake and could potentially outperform, that are perhaps a little bit more under the radar, at least the people that don't follow this industry every second of every day like we do?
So I'll tell you how Grayscale Research thinks about this. On the market structure bill, I think you're absolutely right that Ethereum has more at stake than some of the other players. And it ties back to some of the debate points that you mentioned at the outset. Stablecoin yield. Ethereum is the largest home for stable coins. Decentralized finance and protections for those builders. Ethereum also the biggest DeFi ecosystem. So it affects all of the smart contract platforms and many other things, frankly, in the crypto asset class. But I do think it's fair to say that Ethereum has more swing on the success of the market structure bill than some of the others. Like when you look at the category as a whole, look, smart contract platforms are the cornerstone of crypto investing beyond Bitcoin. They're really a central part of the asset class. Yeah, to our count, there are around 40 or so projects that are large enough, listed on major exchanges, 40, 45 or so, that compete really in this space. And our view is that you have to have a differentiated strategy in order to maintain pricing power and capture fees over time. And so there are maybe 40, 45 of these projects. There's maybe a 5 or half a dozen or so that'll compete in the long run, and they have to have distinct strategies. In our view, Ethereum, a great example of that. It is going for high quality block space, more decentralization, more resilience, and not competing on fees and speed in the same way as others. Other chains competing to be fast and cheap, Solana, Sui, good examples of that. And there's other ways to compete in this market, whether through distribution, customization, the stories for some of these other chains. So our view would be half a dozen or so smart contract platforms that capture the lion's share of the fees in the space. And I think some of them will be leaders today, like Ethereum and Solana, and some of them will be emerging chains that are just getting going, but they need to have a distinct competitive strategy. There's a lot of chains, and not all of them are going to be capturing huge amount of values over time.
Gotcha. Okay. All right. So we're going to start wrapping up soon, but I have a few more questions. For one, we've been talking around it a little bit, but I want to give you a chance to directly address what's been going on at the Fed. I know Chairman Powell's video was I guess, at least on late night shows, was sort of seen as akin to a hostage video. But the content of what he said was pretty direct and very incisive. I mean, he sort of, for most of Trump's, I guess, second term, has been dancing around, not directly addressing, I guess, some of the insults and other things that have been directed his way. But he very clearly said that this is all about political pressure. This has nothing, at least in his opinion, this has nothing to do with concern about, I guess, cost overruns for rehabilitating or refurbishing a couple of buildings. And but interestingly, it seems like he has DC on his side, especially some Republicans. In particular, I know Tom Tillis pointed out that he will not vote for any successor to Chair Powell when I think his term expires in May, until this issue is adjudicated or resolved in some way. So is it possible Trump went too far? What are the broader reverberations for the U.S. dollar primacy, and how do you think that impacts the price movements that we've been seeing and just everything we've been discussing about so far on this episode?
Yeah, great question. Look, we are seeing the macro case for crypto play out in real time through these events and through many others. When I look at the events over the last weekend, it's all about Federal Reserve independence, and that's a term that people are hearing increasingly in the last week. Of course, why is that so important? What does it mean? When we say Federal Reserve independence,
why don't you tell everyone who Arthur Burns was in case they don't know?
That's right. Well, so what we mean by central bank independence in a substantive way is independence from the nation's debt problem and from the political or election cycles. That's what we mean independence from. We say independence from the White House, et cetera, but really what we mean is independence from our debt problem and our elections. And if the Fed becomes dependent on those things, if monetary policy is dependent on the fiscal situation on an election, likely it will lead to a higher average inflation rate over time. That's the nuts and bolts. Less independence means higher average inflation. And why higher average inflation? Well, on the debt, it's because the interest rate is also the coupon rate that we pay on the bonds. We have a huge debt problem. We're making more and more bonds all the time, and we have to pay interest on them. And the Fed, its interest rate decisions directly affect the cost of that borrowing for the Treasury. So the Treasury has an incentive for cheap borrowing. It wants the Fed to keep interest rates low, to keep the nation's borrowing costs low. Same thing with election cycles. President Trump wants to see the Republicans do well in the midterm elections. He'd love to see a hot economy going into that period. So he also maybe has an incentive for at least temporarily low interest rates and fast growth.
I don't know if low is even a strong enough term. I think you would almost prefer close to zero if you could get it.
Yeah, I think he's been very clear on his desire for low rates.
At least one, yeah.
So when you look at exactly 1% or so, I think is the number that he's been advocating. So when you see these, what I would encourage people to think about is independence means independence from the fiscal policy and from elections. And if you create a dependence on those two things, you get more inflation. So what does this have to do with crypto, with investing, right? When there's a risk, the debt problem, the underlying debt problem is the root of all of our issues, and all the demand for precious metals, the macro demand for the crypto asset class. These are all about debt imbalances in the United States and to some degree in other parts around the world. And we are watching the consequences of those debt imbalances on our institutions, on our macro institutions in the US appear in real time. So this is exactly that thesis of playing out. And what it means for me is higher inflation over time, a weaker dollar debasement over time, and persistent demand for alternative stores of value. And that's exactly what you're seeing in markets. And so I don't want to cheerlead these. It's important, of course, as Bitcoin is for our business, and as enthusiastic as I am about the asset, I don't want to cheerlead these types of things or root for them for having. But as a markets analyst, I do think there are the consequences. I do think the consequences of these things are high inflation, dollar debasement, demand for alternative stores of value. And that's where the bid is coming from in our assets. Many other investors watching these same events and moving their capital as a result.
Yeah, and it's a really tricky conversation to have too. I mean, playing with interest rates can be difficult. I mean, I know we had an inflation reading last month, but there's a lot of other factors at play that will sort of drive inflation. I think even more, or I don't know if that's the right term, but in addition to whatever happens at the Fed. I mean, AI. We've talked about this on previous episodes of this show. I mean, the impact of that on productivity and potentially driving down certain costs and lowering inflation there. And then everything that's happening with oil. From us like seizing or obtaining, I think, what is it, like 30 to 50 billion barrels of oil from Venezuela that I think we're supposed to get. And I think Trump pointed out that he wants to bring down the price of a barrel to $50, which I think would actually be economically problematic for certain major producers. Geopolitical strife in Iran. We didn't even get to Venezuela and Iran yet, but depending on what happens there, and I mean, the Iranian regime has famously choked its own oil economy, and not to mention the sanctions that it's under for its bad behavior in the region. Like all of that could also lower inflation. So I mean, theoretically, like if Trump is playing 3D chess here, all this goes well. Like there could be a case that inflation could still stay steady, even if he does lower rates, which I guess would be really great for Bitcoin if oil continues to go down, AI keeps prices down, and we lower inflation. I don't know. Maybe that's the bet he's making. Maybe not, but I'm curious, like now that we have a chance to talk about some of these sort of like geopolitical hotspots, like how do you see that impacting the inflation discussion and correspondingly on the price of safe haven assets like Bitcoin?
Yeah, absolutely. Like a lot of moving parts, and I just try to tie them back to the most basic things. So when I see these events like Venezuela, what does it mean from the standpoint of the dollar, from broad U.S. macro markets? So I would encourage people to think about the bonds. We have a debt problem, a deficit problem, which means we issue lots of bonds. And so the question when I see these events, it says, I think, is this going to mean bigger deficits and more bond issuance? And what is it going to mean for the willingness of foreign investors to buy those bonds? Those are the questions that matter for thinking about the market implications in the longer run of things like these events in Venezuela. Mm-hmm. And of course, if there's a wide range of possible outcomes and nobody really knows how it's going to go, and it could be that it's a very benign outcome where it doesn't have very large implications for our finances or for the appetite for U.S. treasuries. But there are tail risks in both of those directions, right? There's a tail risk that this becomes nation building, which is expensive, as you know, Steve. So that creates potentially higher deficits, more debt, more bond issuance over time. So that's one potential consequence. And the other potential consequence is more regionalization. The dollar is a global currency. People have treasury bonds and therefore dollars all around the world. But if we narrow the scope of U.S. geopolitical interests, say, to the Americas, and we give China more scope in Asia, and we give Russia more scope in Eurasia, potentially it means less demand for treasuries, less demand for dollars in those places. So these are longer run tail risks from these geopolitical events, but I think that those are the material macroeconomic consequences. Is there more deficit debt and therefore more bond issuance? And is there destruction of demand for our bonds because of geopolitical change? I think the answer is yes, in general, but there are small amounts for each of these events. All of the things happening around the world move the needle a little bit on these things. Venezuela, just the latest example of uncontrolled U.S. deficit and debt growth, and questions about how long lasting the bid for treasuries is going to be from official institutions around the world. That's how I try to evaluate these events from a kind of macro markets standpoint.
And I guess in that case, let's go stable coins if we need some additional demand.
Well, and that is potentially another kind of crypto specific consequence. We know, it doesn't seem like Venezuela has a large stockpile of Bitcoin, as was briefly rumored in the last couple of weeks. But we do know that Tether and stablecoin use is very active in that economy. And so that's another thing to keep an eye on, is does this stimulate more use of stablecoins in Venezuela, in the region? That could be also a longer lasting consequence for the crypto industry from these recent events.
Yeah. And for anyone that's really looking for a nice cheat sheet on Venezuela that doesn't want to bother with reading the New York Times or Wall Street Journal, season 2 of Jack Ryan, a tremendous series on Amazon Prime, was literally all about Venezuela and its oil wealth and the impact on U.S. interests. So it's sometimes the truth is stranger than fiction, I guess, is a good way to put it. All right, so we're about to wrap up, but Zach, I just want to kind of give you a chance to share anything else on your mind, any sort of high impact, low probability events that investors might want to keep an eye out for. Is there anything in particular you're going to be watching over the next couple of weeks? I know the Senate Ag Committee is going to, at least is planning to have its own markup session at the end of January. We'll see if that happens. But like what are you going to be watching over the next couple of weeks?
The negotiations around market structure are the central issue over the short term. And look, I would say what I would want to say, Steve, is don't get discouraged by blood in the street. Bipartisan legislation in a very partisan, polarized nation is very difficult to pull off. And so unhappy people and some tough times ahead of this legislation is part of the process. So I'm not necessarily lowering my probability of eventual passage from recent events. These are tough negotiations happening in a real bipartisan way. And that's amazing. That's amazing for the crypto industry that we have a chance of real bipartisan legislation in a very polarized time in Washington. I'll be watching this very closely. I think the ball is moving forward. I think it's very important for crypto. And maybe the last thing I'll say, for crypto investing, which is what Grayscale focuses on first and foremost, the main implication is a reduction of downside risk.
Mhm.
Once you provide a clear regulated infrastructure around crypto, it means that investors have protection, that issuers know how to behave, and you reduce downside risk to the asset class as a whole. To me, that's the most long-lasting implication of what we communicate to our clients when they're thinking about putting the capital to work in this space.
Yeah, I think that's a great way to put it. And I mean, for me, I remember back in the days of drafts like the Token Taxonomy Act and real questions about what is a security, what's not a security, as I think you alluded to it in the very beginning of our conversation. And the fact that those aren't really questions is actually a major sign of progress. But again, it's really important to codify that in law, because if there is a new administration, a new SEC chair, those issues could come back again.
Exactly.
But right now, everyone is sort of copacetic when it comes to that very important debate when it comes to crypto. So let's hope that progress continues. All right. Well, Zach, thanks for joining us. We'll definitely have to have you back again soon. And that's it for today for me. But coming up next on this live stream, Laura Shin sits down with Alex Pruden, the CEO and co-founder of Project 11, to tackle a much longer-term question. What happens to Bitcoin if quantum computing breaks today's cryptography, and how might the network prepare for a post-quantum world? Don't go anywhere. Don't go anywhere. We will be back after a short break.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Thanks for joining this live stream. Before we get started, a quick reminder, nothing you hear on Unchained is investment advice. This show is for informational and entertainment purposes only, and my guest and I may hold assets discussed on the show. For more disclosures, visit unchainedcrypto.com.
If you look at
CEO and co-founder of Project 11. But before we continue, we're going to take a quick word from the sponsors who make the show possible. And I want to introduce you to our sponsor, Walrus, a project we actually use here at Unchained for data storage. Throughout the episode, you'll hear short excerpts from Rebecca Simons, managing executive at the Walrus Foundation. We'll start with this first clip on why Walrus is good for large data files.
If you look at most apps today, they depend on quite a complex mesh of different infrastructure, a lot of which is centralized. Walrus is a decentralized data platform. It's particularly good with large, unstructured data files, and it allows you to store and use those without dependency on any centralized systems. It works really well as part of the SWE stack. It was created by Miston Labs, who are also the originators of that SWE stack. And what that means is natively together, they allow developers to build with trust, ownership, privacy baked in right from the beginning. And what this does is it allows you to build use cases that monetize data in ways that just have not been possible before. So there are whole new revenue streams that are now available to builders to come and build on Walrus.
Again, I'm here with Alex Pruden, CEO and co-founder of Project 11. Welcome, Alex.
Hey, it's a pleasure to be here, Laura. Thanks for having me.
Nick Carter of Castle Island Ventures has been sounding the drum about the threat of quantum computing to Bitcoin in particular. Although this is probably at least a few years out, he makes a lot of valid points about how Bitcoin governance is extremely slow. And that means that developers should begin trying to come up with solutions to prevent issues now. Your company, Project 11, is focused on this problem, not just for Bitcoin, but for all of crypto and blockchains. Before we get to what exactly your company, Project 11, is working on, why don't you just start by explaining what quantum computing is and how that differs from current computing?
So it's a new computing paradigm, first of all, that's based on quantum mechanics, right? Which is, a branch of quantum physics that deals with the very small. Quantum computing is special in terms of from differentiating it from classical computing because it can do certain things that classical computers can't, right? So it uses the quantum mechanical position or principles of superposition, entanglement, for example, to basically use as building blocks for new types of algorithms that, for example, can factor very large numbers much more quickly than a classical computer could. And in terms of what's relevant to cryptography, actually this problem of factoring large numbers, or this algorithm for factoring large numbers, Shor's algorithm, is the algorithm that we would expect a quantum computer to run and that would be the point at which quantum computing is cryptographically relevant, right? So effectively the way you can, there's many great videos on YouTube on this, and I encourage people to check them out, but at a very high level, you can sort of think of a quantum computer being able to parallelize the process of being able to factor a large number or solve a hard problem in a way that a classical computer simply cannot, right? So that's quantum computing in a nutshell. That's why people are excited about it for many applications, but because this problem of factoring large numbers is the basis for security in many cryptographic algorithms, including the ones used in Bitcoin and virtually every other crypto network, this is why we have to consider it and worry about it as an industry.
And when would you project that it would be a threat to Bitcoin, and how reliable are the projections about when it will become a threat?
Great question. And you can probably imagine I get this question all the time. And look, full disclosure, I'm not a quantum physicist myself, right? And we have an advisor actually who, is a quantum physicist from Harvard. He's actually currently was at Harvard and now is at Caltech, right? So we talk to physicists working on quantum computing all the time. We talk to cryptographers all the time, many of whom, are well known in the space and, advise projects, and they're maybe closer to the pulse of kind of post-quantum cryptography. But look, if you poll the audience among these experts, you'll get a giant range of answers, anywhere from 2 to 3 years to 30 to 50 years. I will say, so in short, I think it's hard to project. However, I think the uncertainty, and this is the second part of your question, how much uncertainty is there around this? I think there's an enormous amount of uncertainty around this. One data point, though, and quite frankly, the thing that led me to want to start Project 11 that I find quite interesting is in the last year in particular, quantum physicists have gotten a lot more bullish about quantum computing and its timelines and whether or not it's going to be viable sooner rather than later. And you can just, for example, just read Scott Aronson's blog or John Preskill. John Preskill is a Caltech physicist. He's quite well known. You can just read the difference in what they put out, even in the last few months, and tell there's been a change in their attitude towards this. To them, it is not just 20 years away, and 20 years is a placeholder for a long time. They see a sea change, and that was really driven by a year and a half ago, actually, just about a year ago. Google released a chip called Willow. Some of your listeners may remember this news, but the key thing there was it basically demonstrated that the science problem of quantum computing had been solved. The engineering problem, though still substantial, was basically all that was left, right? And now it's just a process of scaling that up. Now, how quickly will that happen? That's the $1 million question, right? But I think the reason why we started this is there's not a guarantee in this being Project 11. There's not a guarantee that this doesn't actually happen sooner than people expect. And if you combine that risk of things maybe moving a little faster, like AI, for example, I think took everyone by surprise. Many disruptive technologies in the past have come and taken people by surprise. And if you combine that fact or that possibility with the fact that these are decentralized systems that secure an enormous amount of value that entirely rely upon this cryptography that will be broken, like those two things are facts. Bitcoin and all crypto networks rely on broken cryptographic algorithms, and quantum computing can break them. Like we know those things. It's just a question of when. So I didn't give an answer, but I would say, generally speaking, what I tell people is it is not out of the realm of possibility that this happens in the next 5 years. And even the fact that that's possible, I think is enough that as a conservative measure, we should prepare now.
Yeah, potentially even 4 years. I don't know, just from some conversations I was listening to, I was like, oh, they keep talking about 2030. And now that it's 2026, I was like, oh, that's actually 4 years out.
So if I could just say one more piece on this, is important. I think some people think there's going to be a long lead up where you're like, we're going to know it's 4 years out. If you just think about the capabilities of these systems and what they do, either they're going to be used for espionage or someone is going to use them to recover lost Bitcoin, whatever, right? The bottom line is whoever has the capability really has no incentive to share it, right, before they use it. And so I think as we get closer and closer to these systems being more and more capable, I would fully expect us as a public to know less and less about what is the state of the art. So I think that's just an important fact to keep in mind, or concept.
Yeah, and there was a blog post that I quickly skimmed. It was obviously by somebody who's deep in the field, but basically, the brief gist of it is they just talked about how quickly some of the quantum capabilities are developing, and they said, it's kind of like incremental, and then boom, there's like a big leap. And so they were saying that it could seem like something that's further out, and then all of a sudden the timeline just jumps. So I did want to ask, for this moment in time when the quantum computing threat becomes real, what are all the ways in which Bitcoin could be harmed or broken, or Bitcoin holders could be, lose their money or have alarm about their funds?
Great. So the first thing I want to start is a preamble. We're going to talk about Bitcoin because you asked about it specifically. All crypto networks use the same cryptography, but the risks do differ somewhat, right? For example, Bitcoin uses proof of work versus proof of stake, and there's nuance there. But let's talk about Bitcoin for a second, and then if you want, we can get into some of the other networks. Okay, so Bitcoin specifically. So actually, there's two categories of quantum attacks that could theoretically be relevant to Bitcoin. One is the attack that targets asymmetric cryptography. So these are the digital signatures that basically confer ownership. Like the only way actually we have a concept of ownership in the digital world is this concept of a digital signature. Like all the Bitcoin ledger really is a record of who paid whom when, and that who is the digital signature. Like I have the private key, only I should be able to produce the digital signature. What Shor's algorithm, one of the two relevant quantum algorithms, does is let me recover your private key from only the knowledge of your public key. And so I am able to then sign for you, right? Now, we'll come back to this because I think not all Bitcoin is vulnerable because people generally don't just display their public keys. Bitcoin addresses, in fact, are hashes of public keys. But that said, a significant amount of Bitcoin public keys are exposed. We'll come back to that in a minute, though. But I said something in the other category of attack that's relevant is an attack called Grover's algorithm. So Grover's algorithm is really just it's a quantum algorithm for unstructured search. And it's a way that you could theoretically reduce the security of a hash function. Bitcoin uses hash functions all over the place. I mentioned a second ago, it's how an address is basically created from a public key. You hash the public key. It's also, as many of your listeners are no doubt aware, used in mining. That's basically all mining is, right? And so that is a category of attack. That said, this is the last time I'm going to mention Grover's algorithm, because the performance boost you get versus a classical GPU or classical machine, say, from Grover's is just not that impressive. Quantum computers would truly have to be astronomical in size to make that attack relevant. So we don't focus on that. We don't think that's a short-term threat at all, Project Level. The short-term threat is Shor's algorithm. And the reason it's the threat is because compared to the classical alternative, the GPUs trying to factor numbers, Shor's is exponential in the advantage. So that means every basically additional qubit that you add to your quantum computer basically gets you almost another order of magnitude of speed up, right? So it's very, you can't just make your keys bigger. You can't, there's no easy way to mitigate that attack. Okay, so Bitcoin is vulnerable. So effectively what I'm claiming is Bitcoin, the most vulnerable point of Bitcoin is really the foundation, right? Which is this concept of ownership, right? Okay, so who is now vulnerable is the question. Well, it's anywhere that a public key is exposed. Maybe just as a point to make a comment of Bitcoin compared to other places where public key cryptography is used, Bitcoin is special because unlike, say, the web, where we use public key cryptography, like as a TLS connection to this website, like we authenticate, via the certificate authority that whoever owns this website is a real person, etc. Those public keys are typically ephemeral. Like we create them in the session, they get destroyed later, and usually public keys don't stay around forever. Blockchains, they stay around forever, right? Like this is a ledger. It's literally, you can go back to the Genesis and it's there. You can find the record of these things, right? And so the long-lived nature of these public keys kind of makes blockchains especially vulnerable. In addition to the fact that it is the public key explicitly that secures an explicit amount of value. Compare this to like a bank account, for example, where again, we could authenticate using public key cryptography, but I don't know what's in the bank account. Whereas I can look at Satoshi's Bitcoin addresses and I know exactly what I'm going to make by attacking those things. So, okay, to conclude, the main area of concern is the public keys that are exposed on chain. That is approximately, it's like around 35 to 40%. The number fluctuates. We have a risk list on our website. This includes Satoshis, right? So early Satoshi Bitcoin was mined to a pay to public key address, so they were not hashed, as well as a lot of exchange wallets, bridges, basically any business that has on-chain infrastructure where for a variety of reasons, they sort of have to sign twice to the same key. And so what you end up with is roughly a third or so of Bitcoin, of the total Bitcoin in circulation, so hundreds of billions of dollars, is exposed today to a quantum computer. And that represents arguably the biggest, cybersecurity honeypot that's ever existed.
And actually, I'm so sorry, I didn't understand this because I guess I would have thought, so the public key is, where anybody would send the coins, right? So then on any block explorer showing all the Bitcoin transactions, going back to January of 2009, then wouldn't every single address that held Bitcoin be visible and easily scraped from the block explorer? So I don't understand why you're saying only 30%.
Great. This is okay. So great. Let's unpack why. So because in Bitcoin, what we so actually, this isn't like a new realization. People realized this was a problem 10 years ago when they were thinking about quantum and other things. Privacy was another consideration. And so what an address type got added, which was pay to public key hash. And so Satoshi's early coins that were mined were all paid to public key, which was the original thing that was supported, but kind of the de facto way that people were encouraged to spend Bitcoin on was this pay to public key hash. And because Bitcoin is a UTXO system, you spend from one address, I send some to you, say, and then I send the remainder. The remainder doesn't stay in that address. It goes to a new address that I control, right? So this is the whole point of hierarchical key derivation. So really when I'm spending on Bitcoin, because Bitcoin is a UTXO based system, even though I'm spending, if I have good wallet hygiene, I'm only using the address once, right? And so for people that basically have wallets and or follow these practices themselves, they're not actually exposed to a quantum computer, and a lot of wallets enforce this, right? So contrast this. I'm just going to briefly contrast this to a system like Ethereum, where Ethereum has accounts. We don't have UTXOs. There's actually accounts. There, technically, your address is hidden by a hash too, but as you point out, because it's account based, really the second you do anything on Ethereum, you've exposed yourself. And so we don't have a tracker for Ethereum, but the vast majority of Ethereum on chain is exposed. So does that make sense? Does that
Oh, okay. I'm so sorry. So when you said 30%, that wasn't only Bitcoin. That was all.
No. So that 30% number is 30% of all Bitcoin is under public keys that have been exposed, either because they were under the P2PK address type, or someone spent twice from the same address, whether you're not supposed to, but people do. And let me just give you an example why people would. Exchanges are very often exposed wallets. Why is an exchange might you have to sign twice? Well, you want to deposit Bitcoin to sell it, say, right? And you save that address that they give you into your wallet because you don't want to write it down. You don't want to write it down. You don't want to screw it up. Well, now the exchange, to get your money out, has to sign again from that same address, right? So that's how they end up kind of exposing themselves. Bridges have the same problem, right? Where do you tell people to send their money? You don't want to give them a different address. Does that make sense?
Yeah, I guess I'm so sorry I did belabor this, but
okay.
So with the UTXO model, then what happens is you send to wherever, whatever address the recipient is, and then the remainder goes somewhere else. But
right.
Aren't both of those addresses visible on a block explorer? That's why I don't understand why you're.
Yes, the addresses are visible. The addresses are always visible. And maybe I didn't explain this well. The addresses are always visible, but the addresses themselves are not vulnerable. But when you send from a given address, you need someone to be able to verify your signature. That signature verification requires you to expose the public key, the raw public key, not the hash,
okay.
the raw
okay.
public key.
Got it.
When you send, then you're exposed. Okay, sorry, and I probably should have mentioned that very key fact. So
now I understand.
Belaboring it.
Okay, so in a moment, we're going to talk about the threat to other blockchains, but we're okay, maybe not. So we're going to talk about the threat to these other blockchains. So go ahead, Alex. Tell us of the other chains. As you mentioned, so Bitcoin does proof of work, and then we also have proof of stake coins. We have the UTXO model. We have account based. So amongst all the different chains, which types of chains are most at risk, and break it out into risk for technical reasons and cultural reasons.
Great. The simple way to think about this is Bitcoin is kind of the least at risk for technical reasons, but the most at risk because the value is highest and culturally it's very decentralized, quite frankly. So it's hard to solve this problem. We've seen Bitcoin ossify. Other chains are kind of more at risk technically. I guess if by that, I guess to be specific about what I'm saying is, on average, more of the total supply, the public key for that is exposed. Like I said, the Ethereum account model, very often you expose the public key. Solana, for example, which is an ecosystem we've done some work with, there the address is just the raw public key. So there's no everything, 100% of Solana is vulnerable, theoretically, right? Now, on the cultural side, there's an advantage in the Solana ecosystem that I guess theoretically there's a foundation, people kind of look to them, what do we do? There's fewer nodes. You could argue it's less decentralized, although I'm sure that's a big rabbit hole we may not want to get down on this podcast. But anyway, the point being is probably it's a little bit simpler for them to at least coordinate. It doesn't mean it's going to be simpler to fix, but it does mean it's potentially easier to coordinate a fix. Whereas I think with Bitcoin, it's probably easier to fix technically, but much harder to coordinate. And even in the cases where I say easy to coordinate, I want to make sure it's important to clarify here. Any of these ecosystems that go through this change, which by the way, they will all have to be worth anything. And at the end of the day, this is by far the biggest effort, the most significant upgrade any of these things will ever undergo. And I want to explain why. If this is not a situation where ETH1 goes to ETH2, where as an ETH holder, I basically just went to bed and I woke up one day and I'm like, oh, okay, proof of stake is happening and this all seems great. I still have my ETH, it's in the same place. I didn't have to worry about it. In this case, protocols all have to add support for new post-quantum cryptography, and there's consequences to that. These algorithms are very different than what we have. We can come back to that. But the protocols have to do a fix. A. Then all the value, everything, has to move. So wherever you're holding your Bitcoin currently, you will send it somewhere. You have to. Your ETH account has to move. By the way, all smart contracts, if there's any kind of verification logic that uses old BCC keys, which you should read that as stablecoin contracts with admin keys, they all have to get redeployed. So this is the way we like to term this is full lift and shift. Every protocol must migrate to new cryptography. Every smart contract must get redeployed. Every single asset across every single chain must move from where it currently is to where it's going. So that's why like people are like, oh, ETH1 to ETH2 or Taproot, you know, and honestly, those are bad comps. Like this, that's maybe half of the work in the best case scenario.
Oh my gosh. Oh my gosh. Just hearing that and thinking about how, you know, when DeFi contracts get upgraded, or even, looking at things like, you know, back in Ethereum's history, the DAO, just so much money gets left behind. So, okay. Wow.
All right. This is, you know, by the way, just quickly on the Bitcoin side, this is one of the cultural issues that's very hard. Satoshi's Bitcoin. And we can come back. Maybe I'll just mention this. Like, what do you do with the coins that are left behind? It's fascinating. I mean, all of these ecosystems, it's a huge deal. So now I guess you can tell why I got into this problem, because, you know, you're like, quantum, how far is away? But then you realize the scale of this, and you're like, oh my God, it might already be too late if we're starting now.
Yes, which is what Nick Carter was saying. And a lot of people were kind of dismissing the urgency, but I was convinced, not that I, you know, did a ton of research, but I just understanding the Bitcoin community and how it works, and just the nature of, you know, how quickly this technology is progressing, and in like a leap sort of fashion, all of those factors. I just thought, wow, okay. So we haven't talked about your company yet, Project 11. Congratulations. You just announced that you raised $20 million from Nick Carter's Castle Island Ventures, as well as Coinbase Ventures, Variant Fund, Balaji Srinivasan, a host of other funds. And you are focused on building quantum resilient cryptographic infrastructure that helps blockchains migrate before the threat is real. So explain, you know, what that means and how you're doing that.
Great. Yeah. So as hopefully your listeners have kind of been able to put together over the course of this stream, there's a lot of aspects to this. Like there's a protocol layer thing, but there's importantly, I think this user assets all need to move, right? And so for us, one of the big things that we see no one tackling at all is figuring out, hey, they're basically, everybody is currently on an island. It's classical cryptography secured. And there needs to be a new island we all go to. So someone needs to like have this island needs to exist, and there needs to be a bridge to it, right? And so this is the analogy I like to use a lot. Like we're building the place where you put your assets that is secure post Q day. We use the term Q day for the day that a cryptographically relevant quantum computer becomes real. And there needs to be a bridge or a path or a migration protocol to get you there. So we've actually shipped part of the bridge for Bitcoin. At least we have a product called Yellow Pages. So yellowpages.xyz, people can check it out. What that is basically it's a tool that lets you generate a new post-quantum key pair. Now these key pairs are not recognized within Bitcoin yet. And, you know, we hope at some point that standard will be recognized. But the key piece is you sign a digital signature using your new post-quantum key pair. And then you sign another message using your Bitcoin public key. And what you have is an attestation that today, at this point, you are the owner of said Bitcoin, right? So you're attesting that you own this asset in a way that could not be forged by a quantum computer, right? So Yellow Pages was a proof of concept that we shipped, but I think it demonstrates effectively what everyone is going to have to do for a migration. So that's the bridge piece, right? The next step, and what we're focusing on with the money we raised from Nick and other folks who participated in the Series A, is building effectively infrastructure, wallet type infrastructure, where you're able to secure assets today in, you know, independent of protocol migration timelines, but secure those assets in a way, your assets, that in a way that is post-quantum secure, right? So applying post-quantum cryptography at the wallet level effectively. And then hopefully when enough people start doing that, we'll be able to start integrating that cryptography into various protocols, right? But the protocol migration process has to be measured and deliberate. And of course, like take Bitcoin, for example, it's very, let's say, decentralized, we'll say, right? So that's a slow burn. You don't want to rush that either, right? Because there's a lot of consequences. You mentioned the DAO hack. That was a hack. I guess someone made a mistake is maybe the better way to put it, right? And that's a huge risk here. And Justin Thaler from A16Z, we've gone back and forth on this, and he sees the bigger risk of people applying post-quantum cryptography wrong, and then that's the real threat. And I think he's not wrong in highlighting that as a problem. So that's the order in which we kind of aim to do it: is figure out a migration tool or protocol, get people to a place where their assets can be safe, and then ultimately work with the various protocols and providers out there to make their protocol, make them post-quantum secure.
Okay, but yeah, I guess the risk is, so people can do this, to try to hedge against the risk, but then there is still the risk that, for instance, Bitcoin doesn't end up adopting whatever technology scheme is behind Yellow Pages to protect against quantum. So it's like they can do all they want to try to prevent it, but ultimately some portion of it is out of the hands of your company. And okay, got it.
Yeah, definitely. I mean, I wish that weren't true, but I also am happy that it is true, right? Because we're building decentralized. I'm a big believer in the importance of decentralization. Like, we could just ship everything. I mean, this is why Google's is not really a problem for Google, right? They can just ship all this stuff and it's over. That said, I think I want to differentiate between Bitcoin and some other ecosystems, specifically smart contract blockchains. It's actually possible to implement post-quantum cryptography at the wallet or smart contract level in a blockchain like Ethereum or Solana or any of these kind of more smart contract chains, because they're just more expressive. You're absolutely right, though, in Bitcoin's case, Bitcoin as a protocol kind of has to adopt this. So this is why when you ask me technically versus, culturally, which is easier, there are many facets. It's very hard to really kind of unpack all of them. But I would just say, like, for us, an area that we're focused on is the blockchains that have smart contract functionality. You can actually, it's possible to secure assets today, even if a quantum computer existed. And so that's a big focus.
Okay, and so one thing that I am not sure I fully understand is once the true quantum threat is here, as far as I understand, and maybe I'm wrong, the way that happens, there's kind of multiple avenues. So how is it that solutions created today before that threat exists can be tested and be known to be secure before that happens?
You just asked like one of the deepest philosophical questions about cryptography generally, right? Like, how do we know any of this is secure? I mean, the answer is we kind of don't really, right? I won't get into theoretical computer science or any of this nonsense. But the point being is, generally speaking, so first off, what is true? We know that Shor's algorithm breaks elliptic curves, digital signatures, and RSA and things like it. So things that are based on similar assumptions, we know that is broken. Now, that doesn't preclude a quantum computer from being able to break what we think is post-quantum secure. So there's post-quantum algorithms that are based on like a subset of problems called lattices, for example. There's also post-quantum signature algorithms that are based on hash functions. I mentioned Grover's as an attack on hash functions. There's no guarantee that someone in 10 years won't discover a new attack. And by the way, this is actually an important point to mention, a philosophy for when we're designing these new systems that people are putting their assets in. We should not be satisfied with having a new cryptographic standard that we just assume is going to be set for all time. It will certainly, if you just look at the history of cybersecurity, it will certainly be the case that one or more of all of our assumptions or our assumptions will be wrong. And people will need to migrate. Potentially people will need to migrate again, right? So imagine lattices, I referenced a second ago. Imagine we build a wallet based on lattices. Lattices end up being broken, maybe classically, not even quantumly. People have to move to hash base. The infrastructure that we build to truly be future-proofed needs to be what is termed agile, right? So you need to be able to switch quickly. And we need to build in these pathways. I gave this analogy of a bridge. That bridge, but you should think of it as an emergency exit for your wallets. There needs to be an emergency exit that in the case of a hack or some big thing that no one expected, a black swan, call it, people can make their funds safe quickly. No one has built that way up to this point, but I think going forward, it will be critical that the whole space, to the extent we take ourselves seriously and actually want to be the future of finance, we build those systems that way and to ultimately be future-proof.
Yeah, and I was curious, we talked about the differences between the different chains, both on a technical side and the cultural side, but are there any chains that you feel are better positioned than others right now?
I think I would, look, really no one has started, I think is the answer to address this. That said, I think I would highlight the work that's being done at the Ethereum Foundation and people who've been following recently Vitalik's comments. I mean, Vitalik's view is that, hey, we need to make Ethereum decentralized, and that's a little bit orthogonal, but he also believes that it needs to be we need to build for the 100 years. And the 100 years in his mind is like post-quantum cryptography. We need to build that in now. So their lean roadmap integrates this, and we work with Justin, some other folks there to kind of help them spec that. I mean, the work is just beginning there, so I don't want to overstate it, but I definitely think that they, in terms of their attitude and what they've done so far to drive consensus among the community members and stakeholders there has been very impressive. Solana too. I mean, we work with them. I think they're also starting to wake up to this, and increasingly, I think people are starting to wake up to this, and it's great. Bitcoin's always one of those places where the best and worst thing about it is it's very decentralized. And I think there are many people that still don't take this threat as seriously as they should, in my opinion. But I will say it's been encouraging in the last year. We've gone from like quantum computing is not real to quantum computing is not to worry about now. So I view that as progress. I'm like, okay, great. We're moving from here to here, and maybe by next year we'll be even one step further than that. We're building stuff. So I don't know.
And what other types of products are you thinking about building? And do you have business models in mind for how you can make money from your products?
Yeah, look. So at the very high level, the business question of Project 11, like the venture opportunity, we have an entire ecosystem that I haven't checked prices, but I don't know, $3.2 trillion worth of assets that is theoretically zero if this project is not, or if this problem is not solved. So Project 11's value, I sort of see is somewhere between the zero and the 3.2 trillion. Obviously, we're not the only ones who are going to do this, et cetera. But that, I think that's the total addressable market. Now, there's many ways that we could potentially address this, right? So, I mean, and I guess I'll just say that we don't have, I think in terms of how we make money, there's many possible ways we could. We haven't really decided which of those to go down, but I think the opportunities will be limitless. I mean, again, like I said, going back to what I said earlier, it's full lift and shift. Every asset, every wallet, every smart contract, every custody solution, it all has to turn over. And so, for us, our goal is to really build the fundamental standards that define the foundations of the digital financial rails of the future. I believe two things. I believe blockchains will become the basis of all finance. I just think I believe that for a variety of reasons. And I think blockchains, to be durable, need post-quantum cryptography applied. And by the way, this is an important point to mention, quantum computers also offer a lot of really cool primitives that we can apply to these blockchain-based systems. I'll give one quick example. Quantum key distribution, which is a concept where you and I can share a key or a wallet without actually ever transmitting it over the internet or a network, right? We can use the quantum phenomenon of entanglement. That's a whole new paradigm. You can imagine that being a part of a future protocol or different types of randomness generation, et cetera. So again, our goal is to build the financial rails of the future, blockchain-based, post-quantum secure, at starting with the user assets and working our way up. So I didn't answer your question I didn't answer your question at all. But to us, I think the opportunity is very big.
And how did you come to found the company?
Yeah, so I was at previously. Well, first I was in the Army. I got interested in crypto in the Army. Then I was an investor at A16Z, and then I was at another project called Aleo in the privacy space. Left that, and then I was thinking about what to do. And Google Willow happened, and because I'm passionate about this technology, and I saw Willow, and I started thinking along the lines of exactly this conversation. I'm like, oh my God, someone needs to do something about this, because I'm passionate about blockchains and decentralized blockchains in particular. And to me, I just didn't think enough people, or really anyone, was paying attention to this problem. And yeah, that's what led me to get out of my chair, end my break between companies, much to my wife's chagrin, and get back on the co-founder train.
So I did want to circle back to the Satoshi's Bitcoins question. So yeah, I'd love to end on that. Just hear kind of what the challenges are, and what you think could be some of the scenarios of what could play out.
Okay, yeah, I saved the best one for last, the spicy one for last. Another question I get. Yeah, so let me just frame it so everyone understands. The majority or all of Satoshi's Bitcoins. Of course, here we're speculating, right? We assume Satoshi was one person and Satoshi is gone, but the broad notion of Satoshi, they are the founder of Bitcoin, who may or may not be alive. Many addresses associated with him, her, or them are exposed. Like they were early mining rewards, and the public key is exposed, and so people can assume those are lost. And I'm sure there's others that are lost too, right? But people often use this as the example. And so in total, I think I don't remember the number off the top of my head, but I believe it's about $150 billion worth of assets that could be gotten by a quantum computer. And so there's a question. There's really only three options. What do you do, right? So a quantum computer comes along. What happens to these 150 billion? Well, they don't. I mean, if it's true that Satoshi is not alive, they are not alive, then you can't migrate them. They're there, right? So the quantum computer could just get them, right? So that's maybe you add a new address type, but you don't burn those, and then the quantum computer just gets them, and I guess they're a big bit. They're the next MicroStrategy or whatever, right? They've got all Satoshi. So you can let the quantum computer get them. You can proactively decide to burn them. Like the community could come together and be like, hey, these things should be destroyed because let's imagine, I don't know, Rigetti, I just picked a random quantum computing company. They get these, and what are they going to do? Well, they're the public company. They're going to sell them all so they can make profits, and that's bad for the price, blah, blah, blah. So people maybe would say, hey, this isn't really good. We should burn this. The third thing you could do is figure out, okay, look, we're not going to burn them, but maybe we'll put them in the mining rewards in 2100. So that way, like, you know, make it more sustainable. So you could reallocate is really the third option. So it's basically let quantum computers steal, burn, or reallocate. Those are your only three options. And this is a massively divisive issue within the Bitcoin community, as you can imagine, because people feel very passionately. I mean, Bitcoin was founded on this concept of no arbitrary seizure, right? Like, you're not your keys, not your crypto. So this idea of burning or reallocating, I think is very, very offensive to some people in that community. On the other hand, if you talk to some of the more, I would say, markets-oriented actors, MicroStrategy, you know, ETF issuers, people who are kind of exposed if the price tanks overnight, they, I think, are incentivized to think differently. They're like, is it really so bad if we just burn the ones we know are gone? This is going to be a very divisive issue. My personal belief is, I mean, unless this is resolved, there will be a fork over these two things. Because I think these are very different views of what Bitcoin should be. And when you have that in a blockchain-based system, I mean, a lot of times this is what you see. So it'll be very interesting. Honestly.
Yeah, just hearing you say all this, I think about back in the day when I used to write about the block size wars, and I would call it like Bitcoin Civil War or whatever. I'm just like, that will look like child's play compared to this, because especially now when the market cap is so much higher, and then you have like the Wall Street people and the cypherpunks, like the community is even bigger and more diverse, with people who have wildly different philosophies involved. So yeah, it's going to be, well, hopefully it won't come to that, but yeah, I'm not really sure.
Hopefully it won't come to that.
Results.
Yeah, and this is one more reason to prepare, right? Because it will, the worst case scenario is much more likely if this comes and hits everyone in the face by surprise. And I think at the very least now, by framing the issues, thinking through the implications, having the conversation, as painful and acrimonious as there are no doubt going to be, is better than just pretending it's not real, because I just think that's a fantasy. And I think that because crypto has come so far, we've got, I mean, ETFs are issued, people use this, it's real. Like, people actually use this infrastructure every day. I don't think we can afford as an industry to, you know, to be blasé with the threat. So anyway, that's
yeah, unfortunately, I think some of the developers are being that way, but we'll have to. I
tend to agree with you. Yeah,
we'll just follow how that progresses over time. Alex, it has been such a pleasure chatting with you. Thank you so much, and congratulations on your raise. And yeah, we'll have to see what happens.
Yeah, thank you so much for having me, Laura. This chat was great, and we'll just keep an eye on what we're doing, and we'll have a lot more coming soon.
All right, everyone. Thanks so